Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about the changes to retained earnings. We've talked about why they're important, how they affect our financial statements. We've talked about two of the specific examples, changes in estimates and changes in principal. Now it's time to turn our attention to the next of our changes to retained earnings, or the adjustments that cause changes to retained earnings, and that is changes in entity. Companies in today's society are constantly changing. Gone are the days where each company would do one thing, do it very well, and hopefully become successful by selling pottery or selling steel or selling clothing or whatever it is they sell. Nowadays, companies are dynamic and they're merging with rivals, they're merging with suppliers, they're merging with customers in order to create a better company that can make additional profit. Because of that, their financial statements are constantly changing. You see, under GAAP, when relationships between companies change, we have to show those changing relationships in the financial statements. Now, when we talk about this, we're not talking about I own 5% or 3% or 10,000 shares of stock in a given company. I'm talking about when we start to become synergistic. So we own a significant portion of the shares in that other company. The threshold for starting this kind of adjustment is 20%. So once we get up to 20% ownership, we start classifying the shares that we own as equity shares. Because at that point, we're trying to control those other companies, which means that we purchased the shares to give us votes and controlling interest as opposed to simply trying to make an investment and make money. So 20% is what FASB has decided is the threshold for significant influence over another business. So what we're talking about with changing entities is what happens when you get up to that 20% threshold and above. What happens if you drop below the 20% threshold? What happens if you get above 50% and become actually the parent company? And when that happens, then again, the financial statements have to report those changes. Below 20%, above 20%, and then above 50%. Now, most of the time, when we're talking about changes in entity, we're talking about consolidations. That's getting above that 50% threshold. So I no longer just have significant control, I have complete control. I have more voting rights than anybody else. And when that happens, I actually take their financial information, I incorporate it into mine to show us as one big, huge company. And when I do that, I have to actually change my financial statements, both the current year and previous years, all the previous years that I'm showing, just like we did with the change in principle, to show this new entity and the way that it has changed from last year to this year and then on into the future. The good news for us is that we're not getting into consolidations. There's so much fun involved in consolidations that we're going to save it for an advanced accounting class. But one of our key concepts is understanding that while there are some adjustments that need to be made in that 20 to 50% threshold, the significant change in entity comes when we consolidate or drop below that consolidation threshold. So I just want you to be comfortable conceptually with the fact that a real change in entity, the retrospective change in entity, comes because we have reached that super threshold, the 50%. Now, that's not to say we don't have to make adjustments when we own 20%. We do. And if we jump above it or below it, then it does cause some changes. But those changes are treated more like changes in estimate, which means it changes our current numbers, but we don't have to go back and make retrospective changes to our financial statements. So if I'm in year 6 and I get above that 20% threshold, then the year 6 numbers change. Year 7 and 8 will change, but I don't have to go back and restate 4 or 5. And that's kind of nice that I don't have to actually make those changes. So with that conceptual understanding, let's jump in and talk about these changes in entity and how we account for them, at least for that 20 to 50% threshold that we get to do in intermediate accounting. So first off, I want to talk about what happens if it comes out of equity. So we've already talked about equity securities. Equity securities, from a finance perspective, that's all stock ownership in other companies. From an accounting perspective, an equity security, again, is when we reach that 20% threshold. If we're not at that 20% or above threshold, then we treat it as either trading securities that we are day trading or trading on a regular basis, and their profits and losses flow through income. An available for sale security, which means we're saving up for something in the future. If a great deal comes up, we'll take it. Otherwise, we're going to hold on to it until we get to whatever we're saving for. And then in that 20 to 50% range of ownership, then we treat them as equity securities. And as an equity security, we're keeping track not of fair market value, like we do with trading and available for sale. We keep track of our portion of their retained earnings. So if their retained earnings goes up, we show our asset increase. If their retained earnings goes down, we show our asset drop. So we're keeping track of our portion of their net assets. Since we've already looked at examples of equity securities and what those journal entries look like in previous discussions, we're going to start out by talking about what happens if we drop below that 20% threshold. And here's how we do it. First, we're going to transfer the carrying value of the stock out of equity and into either available for sale or can be trading. It's not often that you switch right from equity to trading, but it can happen if you're just trying to sell it off as fast as you can. Most of the time, though, we transfer it into available for sale and we save up until either a great price comes up or we decide we need to invest in something. We then keep track of fair value adjustments, just like we do with all other available for sale securities. The last thing we do is we're going to track and account for what we call excess dividends. So if this subsidiary company, or I guess I should say former subsidiary, because we're below the 20%, pays more than they should in dividends. So they actually get to the point where they're starting to pay what we call liquidation dividends. Then I have to make a special adjustment for them. And let me just stop right here. This is something that we actually do with all trading and available for sale securities. We haven't talked about it in the past. We're going to talk about it now, but just be aware, anytime we own common stock in another company, then we're going to keep track of their dividends and make sure they don't start to liquidate. Let's say I own 10% of your company. I'm not up to the equity stock. I've got it in available for sale or maybe in trading, but because I do own 10% of your equity, when you report $100,000 income, technically 10,000 of that belongs to me. If you pay me a dividend of more than $10,000, meaning my share of the dividend is more than 10,000, then you're actually paying me more than I've earned with your business. Now, if that happens once or twice, it happens. You were liquidating a bunch of cash. Okay, that's fine. But if you start doing it consistently, then it means you're starting to liquidate off the company. You're paying people back all of the profit that you've saved in the business for them, the retained earnings, and you're starting to pay back their initial investment as you liquidate assets. And when that happens, I have to make an adjustment. It's automatic for equity securities. If you're at 20% and above, you're already accounting for this. If you've got trading or available for sale securities, then you have to keep track and make sure that you make this necessary adjustment when and if they start paying excessive dividends. So one of our key concepts of changes in retained earnings is that we have to track these excess dividends for all shares of stock not being treated as equity. So the key concept is what we're doing, why we're doing it, and how we're doing it. So let's take a look at an example of transferring stocks out of equity. So this is Acme Corporation. They purchased 30% control of a shipping company for $1.5 million 4 years ago. Over these 4 years that we've owned them, the carrying value of the investment has grown from that $1.5 million to $1.75 million. At the beginning of year 5, Acme's management team has met. They realized, with FedEx and all these other shipping company options out there, we don't need control anymore. So we're going to sell off 60% of our investment. Now, before we owned 30% of their stock, which means we were accounting for this as an equity security. We're above 20, but we're not up above 50, so we're not consolidating. Now, if I sell off 60% of that, I'm going to drop below that 20% threshold, which means I've got to get it out of equity classification, and we're going to stick it into available for sale securities. So we're going to start with 2 journal entries. The first journal entry is the sale, and the second journal entry will be the transfer of the remaining shares. So step 1 is the sale and the transfer. Typically, we drop below that 20% threshold because we sold off some shares. It doesn't always happen this way. It is possible for us to lose our 20% threshold because they had a seasoned equity offering. They issued a bunch of new shares, and we weren't able to come up with the cash to buy enough shares of this new offering to stay at that 20% threshold. So often there's a sale, but not always. So if it's because they've issued more stock, then you just jump to the transfer and you forget the sale piece. But in this case, we do have a sale. So let's see. We were told that we got cash of $1.2 million. Now we've got to get rid of the shares of stock. So let's make a T account so that we can keep track of this. This is our investment in Shipping Co. And this is typically how you know it's an equity security, because it gets a named account. So if you remember, we started with an investment of 1.5 million. That was 4 years ago. That's what we paid in. And since then, because of our equity journal entries recording our portion of their net income and our portion of their dividends, then it's grown to 1.75 million. We've just sold off 60% of it. So if I multiply that, I get $1,050,000, and that's what needs to come out of this investment account. And the plug is a gain on sale. So I thought 60% of my investment was worth $1,050,000. I got 1.2, so I actually gained 150,000 on the deal. This is to sell 60% of investment in Shipping Co. And let's see. So there's a credit of $1,050,000. So we now have $700,000 left in our account. Now, because we're below that 20% threshold, we have to get it out of this equity account and put it into a generic account. So usually available for sale is something we're saving for. Let's use, I don't know, let's say an equipment fund. So we're saving up to buy new equipment. So we're going to put the remainder of this investment into our equipment fund. 700,000 is being transferred into equipment, and it's coming out of investment in Shipping. And now, since we've dropped below the threshold of 20%, I no longer have any shares of stock in that equity account. This is to reclassify investment in Shipping Co. from equity to available for sale. And again, I'm just using this equipment fund as what I'm saving for. And that's step one. I get it out of the equity account and I'm ready to go. Now that we've got these shares out of an equity classification and into available for sale, we're just going to treat the stock as any other available for sale shares that we might own. So we need to look at market value, and then we're going to look at that new piece, keeping track of the excess dividends or the possibility of excess dividends. We'll work on that next time. We'll see you then. Thanks.